trading at its best.
Okay, welcome everybody to the weekly webinar today. For those of you that this is your first time, I just want to quickly introduce myself. I'm Mike Swanson. I've been trading for almost a decade, taught thousands of traders how to become profitable in the markets. And if you've been following any of these blog posts, what we've basically been doing is kind of summarizing what we're a topic, and then we come into these webinars, we go to the charts and get into more detail. So before I get too much further into this, let's do a sound check, make sure everybody can hear me okay. If you can just type a Y in that chat box, and that'll be where you can ask questions if this is your first time into a GoToWebinar. Okay. Okay, great. So everybody's good there. Sounds good. So let's move right along. So here's what we're going to be talking about today is why is scaling out so important? Okay, you've probably seen a lot of different strategies that suggest scaling out, but they really don't put a lot of emphasis on why and how that it can help you so much. So we're going to talk about taking profit at multiple levels, and that's going to make it so you'll learn, why you don't need to have a perfect exit. This is why traders, I think, have a really hard time becoming profitable in the markets, is they always feel like they've got to get the most out of the move and close their entire trade out at the absolute best price. And I'm going to show you how that's not necessary. And we'll look at some scale out examples on the charts. Okay, so while we're talking about some of this stuff, I'm just going to move over to the charts, and so give me just 1 second to bring those up. Okay. I'll just bring up a euro-dollar chart. Now, pretty much in all of these webinars, when I bring up charts, we don't pay a lot of attention to what time frame or pair that we're on, mainly because pretty much everything I teach can be used on any time frame, and it's not dependent on 5-minute, 15-minute, daily. You can use it anywhere, and it's just as effective. So the same thing will apply to what we're going to be teaching here today. So I've got let me make sure you guys can see this chart. I just opened up a 1-hour chart on the euro, and everybody's seeing the charts okay? Maybe I'll zoom in a little bit. A little easier to see for different screen resolutions. Okay. Quick note, Glenn has just asked a question if this is being recorded, if he has to leave early, or if anybody else, if you guys want to review this, we definitely record these, and we shoot out an email, usually on Monday. So just keep an eye out for that email, and you can watch the replay after this, when we get done with this webinar, like I say, on Monday. Okay? So let's go ahead and let me go ahead and give you guys a little bit of an idea of kind of a cycle that happens with traders that don't use scaling out. Okay, so a lot of you have probably experienced this is you get into a trade. Let's just get my little drawing tool out here. Let's see, that'll work. Okay, so a lot of you have had this happen to you, I'm sure. You've gotten into a trade, somewhere in here. Or let's not do that. Sorry about that. Let's back up a little bit. I'm going to make it so we can't see what's coming. This is what we've been doing lately is looking at the markets as if it were live, okay? So we're going to do the same thing today. We're going to look at it as if this is the current market setup. So let's look at it as you guys, a trader decides to sell short somewhere in this bar, okay? So you've sold up here, and the next bar comes along. There's lots of momentum. And then the market starts to stall, okay? And now you've watched your past trades, and it seems like every time the market gets this momentum and stops, that the market turns against you, and you end up losing on the trade, or you're always looking back as I should have just gotten out right there for, what are we up here? In this example, you're up about, 30 or so pips on this. It's taken a couple hours. So a lot of traders are going to get out. I mean, there's many different situations, but we'll just look at it as you, for some reason, felt like it was going to turn and you took the trade out right there. Okay, well then you watch the next bar and momentum picks up again. And you're thinking, man, now I really wish I would have stayed in. And then here you're thinking, okay, it's back up now. I'm glad I did get out. It's probably going to turn now. And those that didn't get out here, maybe now it's the time. Now you're thinking, okay, it's heading up. I'm getting out here. Okay, market starts to turn and roll over. Market goes back up, all the way back up to the entry. Okay, we're just going to kind of cruise along here. Eventually, you do see it push through, and it went up, 150 pips into profit, 200 pips. You guys experienced this before, where you're in a trade, you got out over here, and it looked like a great exit at the time when the market went up, but then you miss out on all this movement on the way down. I'm talking, from up here to here. Now we're looking at 112 pips instead of this little 20 pip profit. So I just wanted to give you an example of what you guys have probably experienced. Is it's very difficult to find a perfect exit. And what we're going to be showing you here today is scaling out so you don't have to get that perfect exit. Okay, so the basic concept here is when we take a trade, you don't just take a trade, say with a mini lot. What you're going to do is you're going to determine what your risk reward ratio. You're going to determine your stop loss, all that stuff that we're not going to talk about today really, but eventually you're going to come up with a lot size. And let's just say, for example, in this let's say in this example, you decide that it's 0.5 lots. Okay, that's really tiny. Let's just bump that up. Okay, so you decided at that time you needed to trade 0.5 lots. Okay, well what we showed you here is most traders, when it comes to this point, they're just going to close out that entire 0.5 lots. So they'll have no position left, which means when the market eventually pulls down over 100 pips, they don't get anything out of it, right? Really common sense here, but let me show you how the scaling out approach would work. Rather than closing out our entire trade right here, we're going to close 0.1 lots. Okay, so we're going to close out just a portion of our trade right there. So sure, we felt like it's going to go up. We're just going to close out a portion of our trade, so we still have 0.4 left. So in case the market turns down like it did here, we're able to get out and make a profit on the remaining position. Okay, so I'm not going to cover all the too much more detail than that and on just the basic principles, but that's the idea. Is you take out a portion of the trade. Okay, then let's say it again right here. Let's back up again here. Okay, let's say you took out your portion. Okay, it went up, came back down now, and then here it stalls again, and you're feeling like it's going to bounce. So fine, scale out again. You have that option now because you're still in the trade. So here you could close another, you could close another 0.1 lots or 0.2. You can do it however you want. Just write that in here. Okay, so here you closed out another 0.1 lots. Kind of covering up my text, but anyways, you guys get the idea. You're closing a portion of your trade along the way. That's the basic principle of scaling out. So that by the time it's down here and you decide, okay, there's the bottom, either you can close the 0.3 that you have left or close another 0.1. Maybe it's going to keep going. But the idea is you didn't have to pick the perfect exit. Along the way, you thought this was the perfect exit at that time, and maybe it could have been. And at least you would have made some profit, pulled out some profit on that trade before it did go up. Okay, then the next time it comes down, maybe this now looked like the bottom. We don't know. So we close out another part of our trade. And it's okay if it goes because we're still in the market. Does that make sense to everybody? Let's see, I got a comment here that traders seem to get out in and out early. That's just the broker looking for short traders at a better price, which generally bulks up the sellers, and it goes and finds sellers and then continues. So yeah, there's all kinds of strategy based off of these concepts as well. But the idea is you can avoid all of that headache and worrying about if you pick the right exit by breaking your position up into multiple pieces and then just closing out a little bit at a time and giving the market room to eventually make that move. So you're on it and you catch the move when it happens. Now some of you are going to look at it as you can't trade 0.5 lots or you got to trade 0.1. Well, what you need to do, and we've had a webinar where we talked about this in the broker webinar, and we talked about making sure when you open a trading account that you have all of this stuff figured out ahead of time. If your broker is only going to allow you to trade a mini lot and say you only have $1,000, then you need to find another brokerage or change your account type to, say, a micro or a nano account, where you can trade down to 0.01 lots, or where they turn your account into a cent account. So there's other options so that you can still trade, take your initial trade with a low risk percent, and then still be able to scale it out. Okay. Yep, there's micro platforms in the nano where they go and turn your account into a cent account, things like that. There's definitely options if you've got a small balance and you're trying to apply this technique. And the same kind of thing goes when you're up on daily charts, where you have to have larger stops. The same thing applies. Just make sure that your broker's minimum lot size matches with what your trading plan is going to be all about. Okay, so we're not going to get into that too much more detail on that one, since, like I say, we did do a full webinar and we wrote a blog post on that. You can go back and review at TradeWestForex.com/blog. Okay, so let's go ahead, and now that you guys get the basic concepts here, let's go ahead and look at some examples of how and when should you do this. When should you scale out, rather than just having some intuition here thinking it's going to go up, or based on some of your past trades, since we really don't want to be doing that. We don't want to say, okay, my last trade had this happen, next time I'm going to make sure I get out right there, because your last trade doesn't have much effect on what your next trade's going to do. Okay, so let's still go ahead and give you guys some strategies here. The first one's going to be a little bit of a review. It's going to be called the market structure high and low. Is there anybody that has not heard me talk about this, or that does not understand market structure high and low? I've taught this in a couple of our recent webinars, and it's just one of my favorite reversal patterns that you can use for scaling out. Okay, let me just I'll just go ahead and show you what it looks like. Okay, let's say that we were a buyer right here. We caught this nice move, but we're wondering, when is this thing going to be over? When should I scale out? Well, we definitely would not want to be scaling out right here in the middle of this move. A lot of traders are getting out here and here thinking it's not going to break as they're watching this candle move. Some think this is the top. They think this is way too fast of a move. It's over here. Some got it right, but most of the time you're not going to get it right. So you have to have some strategy to help you stay in these moves. Okay, so here's the market structure high approach that you'd find a way of scaling out of this. Okay, so what we have is the market makes a high. We want to see a higher high and then a lower high. And then if the market breaks this low, we scale out. Okay, and then if it does that pattern again, high, higher high, lower high, low, we move it up. So we're no longer going to look at this point, we're going to look here. Okay, let me clear this all off. I'll draw that again for you guys. Okay, so this one already failed, it didn't break, so we wait. Okay, it forms it again right here. Here's your high, the higher high, the lower high, and it breaks right there. That's where we're getting out, is right there. Okay? That's where we're getting out of that. We're not getting out entirely, though. Okay, remember, we're going to take, our whatever position size we've got here. I'm not going to be able to draw with my mouse very well, but 0.5 or whatever you've got here, we're just going to close out 0.1 on that trade, right? Or whatever we've determined how many times we're going to look to scale out. So we're still in this thing, waiting for the next swing up like we got right here. So we're still riding this move up. Everybody else thought this was it. It's over. They sold. It's done. And the market just made its way down, but eventually shot back up. And so now when it rides back up, we can look again for that market structure high. Okay, so it's not the same as the engulfed structure. Some of those candlestick patterns are similar, but this one's just they call it a market structure high and low, and it's used in stock market. It's used in all kinds of different instruments. So, okay, so here we are. We've got a high, a higher high, and the lower high, just slightly lower. So we mark that low when the bar closes. That's where we scale out of the again on the position. Okay, so now when we're down here buying, we rode this thing all the way up to here now. When we've taken out two pieces, we've taken out, we've scaled out twice, right there and right here. So everybody else that was getting out on the way up, or even at the top here that thought they did a great thing, missed out on this next move up because they weren't applying the scaling out. Okay, so then again, see, this just keeps going on and on. This is how you catch these big moves. So sure, it comes screaming down, but it didn't even go to break even yet. Keep holding the position. And eventually it spikes up here again. Now you can mark the market structure high again. I can see it. It's about right here. You've got a high, higher high, lower high, breaks the low. You scale out some more right there, right? And you make another good chunk on the trade. And I don't know how far this move keeps going, but you can see it, you just keep scaling until your full position's out. And there's a very good chance here that you picked up, there's the last market structure high right there, about 127 pips. Do you see how now this little spike up doesn't look like much? I mean, 50 pips if you got every last pip of that move, where you could get twice as much scaling out. Okay, and then when it eventually takes a dive down here and doesn't seem to be going anywhere, you could have your rest of your trade at break even. That's fine. You've made a bunch of money along the way. Or you keep scaling out off those market structure highs, and you'll eventually be fully out of the trade. Okay, so let me clear all this off, and let's look at, that's just one example. I've got more to teach you here than just the market structure high and low. But let's look at the low really quick, just so you guys understand that part. For those of you that this is your first time seeing this pattern. Okay, let's go right here, say we sold. Okay, the reason I'm showing all these profitable moves is because that's where we're looking at scaling. We're looking at it as, hey, we've got a profit. How do we protect it? How do we make sure the market doesn't give it all back? We don't give it all back to the market. And the scaling out approach helps us so we don't have to worry about getting a perfect exit. So that's why I'm doing it this way. So here we are selling. We've got a nice profit. Okay, is this thing going to take it all back? Well, let's look for that market structure low in this case. Okay, so here we have a low, lower low, higher low. That's what the market structure low looks like. Low, lower low, higher low, and then we mark the high when that bar closes. If price breaks there, we're scaling out. Okay, so let's see what happens. And there it broke. My little drawing's moving along, but you guys get the idea, I think. It broke that high right there, so you scale out some of the trade right here. Everybody thought this was the bottom, it's taken off, there's support, whatever. We just scale out because we don't know for sure. We don't want to be wrong and miss out on a big move. Okay, market kind of pulls back, and it looks like everybody was right, but we're still not sure. Okay, it eventually pops up here, tests your entry area where there was some support. Maybe you do scale out there. Maybe you're, hey, it's at break even. This thing could take off, and I want to reduce my exposure. That's fine. That's another way you can use this. You could close out another piece of your trade here. You still got 3 parts open, or however much you divide this out. You don't have to divide it by 5. You could cut it into 3 or cut it into fourths. But here we're out another piece, and the market makes another dive down. Here's the market structure low forming again. It didn't break the high up here, though, of that market structure low pattern. Oh, actually, this one did, though, right here. Let me mark that one for you guys. Okay, so here's a low, lower low, slightly higher low, and then the high, and it breaks it right there. So you could scale out another piece. So now you've got 2 left, or you still got a little bit left. Let's see what happens. Okay, now it's heading down again. Here, market structure low again. And there's the break of the high right there. So low, lower low, higher low, breaks. So you've only got a little piece left now. So see, if the market goes all the way back up here and you're down, you could just get out and say, I'm done with the trade, because you've made all these profits along the way. Okay? So that's the market structure low and high approach to scaling out. Okay, so I've actually been looking at that. Anthony here is asking, can we have a robot that would suggest scale out and endpoints? That's something I was looking to do with Momentix, our trading software that shows entries and things, and we use scaling out is building in something that just says, hey, here's the pattern, so you don't have to worry about missing it and an alert could go off. Or that might even be something we integrate into our latest project, the Informer. So we'll have to look into that, but if we get something like that put together, I'm sure we'll talk about it in an upcoming webinar, one of these webinars. Okay. So let's see. I just have a comment coming in here about, let's see, profit and first strategy. Well, here's the way I look at it is the reason scaling out is really helpful is, sure, sometimes you're not going to get out enough before it comes back up, and this is not a perfect strategy, but the idea is if you keep your stops tight, keep your risk to reward ratio in check, if the market takes off, if the market only takes off and gives you those big moves, say 20 or 30% of the time, if you make the most of it and you have the right risk to reward ratio, you might hit 10 to 1. You might hit a really big profit with a small risk, so that every other time it wasn't working out, you've made it up on these couple trades that it does work out. I mean, you see this all the time let's go to the daily, or here we can stay on the hourly. Let's just zoom out. Okay, look at this giant move right here. If you were a trader that was buying somewhere down in here, or you don't have to buy the bottom. I mean, sure, you could buy right here, right? Well, if we were looking at this, if we were to zoom in and go through all this, we'd see maybe you scaled out here, and then maybe your stop's right down here, right? So you made a nice, risk to reward 1 to 2. Risk to dollar made $2. Risk to pip made 2 pips. You could multiply it out, whatever you did there, to see how much you made. But the idea is, when we keep going up on this and we start to scale out again, and we scale out again, and we scale out again, somewhere up here, and maybe we do finally get the last scale over here somewhere. Well, now you're looking at 400 pip move with a, say, 50 pip stop, 1 to 8 on that move. So, you get one of those. Then when it doesn't work out during the choppiness, or you're not doing so well, this move helps make up for a lot of that, what you're losing in the meantime, waiting for these big moves to come. The Forex has a lot of trends in it. It's not trending most of the time, but there's a lot of trends that break out that can make up for it if you ride them out like you should with the scaling out approach. Okay. So let's move on now. That's the market structure high and low. Let's take a look at, there's many ways you can do this. You don't have to use something really technical and special. You could simply look at a trend line break, support or resistance break. I'm just going to clear off all this stuff. Okay, so you could be looking at support or resistance. Let's say you were a buyer. Right here. Okay, so when the market heads up and bounces back, maybe you didn't get out there. Next time it heads up and finds resistance, it could have broke out. We don't know. So at that time, we could be getting out right here, seeing the hesitation, or even on the way back, scale out. We could take some of it out. If nothing else, we took some profits, reduced exposure, so when it heads down and tests here, we could get the rest of it out. And that's still better than what everybody else is doing. They didn't know what was going to happen at all, and they get stopped out completely on the trade. So that's just, you can look at support and resistance, you can look at trend line breaks, you can look at all the basic stuff, because now it's not a big deal. You don't have to worry about, oh man, the trend line break ended up holding, or because now it's fine. If it ends up holding or ends up breaking, however you were using it, you only scaled out, and you're still in it. Okay. Now let me show you another one I really like is using risk to reward ratio as a scale out, as a reason to scale out. Okay, so let me give you an idea on how that would work. Let's say I bought right here. I was looking counter trend to buy this reversal, and I'm going to zoom this in a little bit. Okay, so I bought this move. Oops, that was the wrong one, right here. Okay, so we bought right here, and what we're looking at is we're trying to figure out, how far up is this move going to go before resuming this downturn, right? Okay, so what we can do is let's figure out where our stop would have been on this trade, and that's how we're going to determine where some of our exit points could be, our scale outs. So let's say you decided to put a stop out here. Okay. It doesn't matter where you did this. Usually, like I've taught in the past, I don't like to use the last swing point. Let's say we don't even do that. Let's say we feel like if it's going to come test this level, it's going to break it. So we're not even going to put it below there. We just know that, let's just say we pretty much put it right at that level, or right around the level, knowing if it tests, it's probably going to go through. Okay, so that looks like that's about 20 or so pips. Okay, so I only did this to show you how we're going to do the scaling out now. And this is the risk to reward approach. So once you know where your stop is, you can set your targets at 1 to 1, 1 to 2, 1 to 3. So here you'd be 20 pips. So what would we do? We'd set our target, our first target at say 20 pips. And that would put us at about 80, right about right here where that drew that line. So you would scale out when the market reaches that level. Right there. Take a little piece out. Okay, when the market pulls back, you're happy that you have a profit there, you could get the rest out at break even. Or if you feel like this level's being tested, get it out and you still have a profit. If not, the next target could be 1 to 2. So that would be a 40 pip target. Okay, you'd put that up here at about, it actually ends up about right there. 40 pips from 60, so about right there. And you made a nice exit there just with the risk to reward approach. Now you've got 40 pips. So now when it comes back down and starts to go against you on your remaining, say you finally exit the rest right here when it does break through. Can't really see that, but on that bar right here. Everybody else is losing money where you have profits out here. You made 20 pips, you made 40 pips. Now when you're down on the remaining 20 pips, if we were to go back and do all the math, you're still in profit. Is everybody following me? I know I'm probably kind of moving fast. I'm just trying to teach you guys as much as we can in these short webinars. And like we saw earlier, some of you have to get going. You've got things going on, and we kind of try to keep these short around, in less than an hour. So if you guys want me to recap on some of these things, or you want something clarified, just feel free at any time to type in a question in the chat box. So as far as scaling in, we could possibly have another webinar all about scaling in. But I mean, it's a similar concept. It's instead of having to worry about exit, best place to exit, you'd be looking at, okay, I don't have to worry so much about the best place to enter. So, a scaling in approach could be maybe you thought the top was right here. You scaled in, or you took a trade. Normally, everybody else would get a full, 5 mini lots in, for example. And when it went against them, they couldn't do anything about it, and they got a bad entry. It looks like a bad entry at that time. Well, scaling in, what you could do here is put in half your trade, or a quarter, or a fifth, like we've been doing here. Put in, 2 mini lots. When the market goes up and starts to turn here, you could add to that position somewhere on this bar, and now you've got what they call cost averaging. But I don't want to confuse you guys and get into too much more detail than that. But you can see how that can help you a lot, where you don't have to pick the perfect entry. And it doesn't always have to be on tops and bottoms. It could be on breakouts and things too. Okay, so let's do another example with this risk to reward ratio approach. This one kind of the move fell off eventually. Let's look at a bigger move. Okay, let's just look at you did get in on this bottom here on this buy on this move up. Okay, it was consolidating. You decided, say, to buy right here on the break back up. It looked like it was going up, and you decided to buy right there. You put your stop in, which maybe that ended up being somewhere out right in here, right? This is not it doesn't really matter what we're doing with this right now. This is just an example. So it doesn't matter exactly where we put this. It ends up being 30, let's just make it easy and say 40 pips. So somewhere out here, 40 pip stop. Okay, so what are we going to do here? We're going to see, okay, where is a 40 pip profit going to be? Well, our entry is 35.26, so that would mean 35.66 would be 1-to-1. Okay, and you guys can decide. Everybody's strategy is going to be different. You might have a strategy that your max target is going to be 1-to-1. So you might look for 1 to 0.25, 1 to 0.5, 1 to 0.75, that type of thing. It's all up to you, but I'm just, to keep things simple here, we're going 1-to-1, 1-to-2, 1-to-3, all the way up until the market comes back down, we decide to get out. Okay, so 1-to-1 is 66, so you're going to take, if you've got 0.5 here or one standard lot, whatever you've got, you're going to shave off some of the trade right here. Take off a mini lot, take off 2 mini lots. Okay. Then what we're going to do is look at what 1-to-2 is going to be. We're risking 40, so 1-to-2 would be 80. So that's at 0.6, right at the top of that bar. See, the nice thing about this technique is it's not relevant to the market so much. So sometimes you'll see that happen. You'll see that you've got the exact top on a trade, which is great. Okay. So here you've got 80 pips out now, so you can say, okay, the next target will be 1-to-3. Where's that going to be? Well, you're risking 40, so 40 times 3 is 120. Our entry is 35.26. That's 36.46. So if the market gets here, we're going to take more out. If it starts to come back, we could look at our market structure high. We can use a combination of all of these techniques for scaling out. Okay, so the market ticks along, and let's see if it makes it up there. Oh, right to the pip pretty much on that one again. Top of that bar, you've got another 120 pips. Okay, now the market's showing signs of heading down. Maybe you finally just say I'm out right there, or maybe you don't know. Maybe it's going to go to 1-to-4, and maybe you're just going to move the rest of your trade, to break even. So if it comes down here, you're going to get out. Let's see what happens. Okay, that one eventually would have hit the break even. But you've made 40, you've made 80, you've made 120 pips scaling out on these, so it's fine to break even on the rest. So hopefully you guys are beginning to see how this technique can help you a lot staying in the moves. I know a lot of you just want to get in here and ride the trade for a couple bars, and that's fine. You can do all of this in a couple bars as well. I'm just kind of drawing things out because we don't get to watch the bar movement. Of course, we're looking at hindsight here. So, if we were able to go back and look at, say, you sold right here, you could be scaling out all throughout this bar and into these other couple bars, and maybe by the time that bar closes, you've already scaled out 2 or 3 times. But we can't really demonstrate that. But you guys get the idea, I think. Just try to get the biggest chunk of these moves, and the best way to do that is to have multiple exits. 4 or 5 times is fine. Maybe some of you will go out and scale out 10 times. You'll take a standard lot or a mini lot and break it into 10 micros, and you'll just keep riding that that trend as far as you can go. And that way, especially if you're, say, on the daily charts, the markets can really trend for years. I mean, look at this top. You've got the top right there. To the bottom is, that was over a year, and that gave out 2,800 pips, 2,900 pips. So if you're a guy that got in short, maybe it wasn't up here, but still, if you found, okay, it's breaking right here, or even over here, that you get into that, you could be scaling out all along the way. If you scale out 4 or 5, 10 times, whatever it is, They don't have to be those perfect exits. It could be right here. It could be right in the middle there. Could have been here, not even at these bottoms. These are still, they look like great exits along the way after you go and look at the whole picture. Okay, right there. Maybe that's your fourth exit. As it's coming up, you continue to exit all along the way, and eventually maybe you took it out at break even right there. But you made all these nice, 290 pips, 660, 1100, 1200, 1000 pips. When it hits here, you've made a nice chunk of profit along the way. Okay, so I want you guys don't just go out and try this for a few days, because there's a good chance you're going to struggle with it at first. And it's going to take some practice like anything else. So I really challenge you guys to use this every day in your trading for a whole entire year. Use it consistently in your trading plan, because it might not work for you for a month, and then the next month it could be great. You could catch one of these amazing moves that just you make hundreds, maybe thousands of pips depending on what time frame you're trading on. And that's when it's going to pay off and you're going to see the benefits. How do you handle those deep pullbacks? So you're talking about right here. So the market hits right here and it just pulls back really strong, 50% pullback of the big move. Well, this is again where we don't have to worry about it so much if we've been scaling out along the way. It's fine that if the market gives it all back, the rest of our trade gives it all back here at break even. Because as long as you're scaling out here along the way, not even at these bottoms like I say, most of us are not going to be able to find that bottom. We're going to be getting out up here once the turn's already taken place. Maybe you're getting the bottoms, like I say, with the risk to reward approach. Let's just look at this example with the risk to reward approach. Clear off some of this stuff. Okay, so you're in short, let's just say right there, actually, where it would have potentially broke even over here. Okay, so that's 36.94. Let's actually keep it easy and go with that. Let's say we're in at 3,700. Oops. Okay, so 3,700, and let's say our stop is, you're on a daily chart, you knew that there was all this consolidation it was going to come back to, like I said, we're not paying much attention on strategy of where we're putting our stop, we're just using it to demonstrate the scaling out. So let's just say it's at 4,400. You plan this out that this is going to be a very long-term trade in this example. Okay, so you've got 700 pips here. And so you say, okay, 1-to-1, I'm going to take it out at 700 pips profit, which is 3,000, right down here somewhere. So as soon as it hits right there, you made 700 pips. Okay, if it goes to 1,400 pips, 1-to-2, you take out another profit. That's going to be right here. Okay, so you've got another 1,400. So you've caught a good chunk of the move with just those two exits. So when it comes all the way back up here, let's say you didn't use anything else, you just were waiting for the next target, it's fine to say, okay, it's at break even, I'm just going to take it out. Or if you didn't do that, and if you let it hit your stop, it's not there yet, but say it eventually does hit your stop, you've still made 1,400 pips and 700 pips. It's going to help offset this loss on the remaining position. And I can tell you by the math, I know how the math works out here, that would be profitable. Okay. Actually, let me make sure that you know that it depends on how much you're scaling out, how much you've scaled out at those points. So that's really important. That's why sometimes you might, if you're using something like this, you might want to only scale out 3 or 4 times, because this risk to reward approach, it's probably pretty unlikely with that kind of a stop that you're going to get 4, 5 to 1, 6 to 1. I mean, scaling out 6 or 7 times is really not very, not very typical. You're not going to see those large of moves in an example like that. Hopefully that makes sense. You guys will see this when you start to try it in your own strategies. But let me tell you, you guys are going to have to adapt your strategy quite a bit, you're going to learn. Because what you're used to, like I explained in the very beginning, most traders are used to, for example, if they sold right there, oops, let's back up here. Okay, so if most traders, if they sold, I don't know what's going on here. I need to scroll back a ways, I guess. Must have deleted my arrow. Okay, there it is. It's hiding way over here. Okay, so most traders, if they've sold right there, they are, when it hits down here and starts pulling back, they're entirely out of their trade right here, knowing that, hey, I don't want to give it all back, and they're done. And so that's a much shorter term trade and a much different strategy than what we're looking at here, where we're going to draw it all the way out. Okay, so but if you want to stick with these shorter term, less candles, in your trade, what you'd have to do is adapt what I've taught here today to to what you're doing here. And the way you do that is you probably wouldn't be using a huge stop. You wouldn't need to if you're looking at these short swings. Your stop might be right here, and you're going to be looking at these short-term little pullbacks, the market structure lows, to scale out. As well, you're going to see a scale out right there. Your risk to reward now is going to give you an exit about right here. So you can adapt it as the idea, I guess. But you're going to have to make some changes to your strategy a little bit and to your approach to kind of fit this in. But it's well worth it. I hope you guys can see the potential of this. So you guys go ahead and let me know any questions you have. We're going to get close here to wrapping it up. Let's see. Yes, that's right, Edward. The more you divide out the lot size, the more you're going to have to make to, on each of those trades if the market does end up turning and going back. That's why, like I say, you have to kind of fine-tune and adapt this to your trading strategy. You might find that you just need to scale out twice, take out half and then close the rest. That might work for a certain trader's strategy. Or you might find that you're going to hold the trade over 20 or so swings, so you're going to want to scale out 5 or 10 times, and then that is not a problem for you because you're holding out for these massive moves. And it didn't really matter where you went short. In this example, scaling out 5, 10 times would have been fine. Okay, someone's asking, can I show an example where the entry was very badly thought out and the market has almost immediately gone against the trend direction? Sure, I can show you how you can handle something like that. Let me clear all this off. So let's say, let me zoom in here and make it so we can just do it just like we've been doing before. Is let's not look ahead. Let's not use the hindsight approach here, and let's look at it as you saw this break. Oops. You saw this breakout. Maybe you're a breakout trader, and so you sold that bottom. Okay, let's say you sold right there. So just like we had a suggestion here, going over an example. Here's a great example, right? You sold and the market shot immediately against you. Now you're down. You don't know what to do. Well, we'd have to determine where you ended up putting your stop on this. But let's say you've got an approach where you're going to scale out as it goes against you as well to reduce exposure. That's maybe your approach. So let's show you how you could have done that. Let's say you're sold here at 39.57. We're on a daily chart. So let's say if it goes against you, if the market moves up, every 200 pips it moves up, let's say you close out your trade. So this is a little bit different than what I've been showing you, but it's definitely another way you can use these techniques. Okay, so you're in here at, let's get back to, put a line on the chart. Let's say you're in the market at 39.50. Okay, so 39.50, oops. Okay, you're in at 39.50. Let's say every time the market moves up 200 pips, you're going to scale out if it moves against you. So you take, say, 5 mini lots, you're going to take a mini lot out 5 times. Let's take that approach. So you've got 200, it would be at 41.50. So if it shot up like that, take some off. Reduce some exposure right there. Okay, so now if it goes up further against you, you have less at risk as it continues up. Now, so if it goes up to another 200 pips, that'd be 43.50. So we're planning ahead. We know what we'll do. If it goes to that price, we'll take out another mini lot or another part of our trade. Okay, in this case, it did go there. So we're out another portion of our trade. Okay, and if it goes up another 200, you know, you don't have to be that aggressive. That's a lot of room, but it depends on how far out you're going to ride it, right? So we'll say this is another 200, be 45.50. Okay, right there. And it didn't quite get you there. Starts making its way back down. Might have got you there. You know, if it did, that's fine. We could have scaled out. But let's say it didn't. It was really close. Okay, now the price is taken off. Now at this point, you're in profit. So now you can start using the scale out. Here's your market structure low. You can start taking some profits now. Okay, so here is market structure low breaks the high right there. You can take, what's that going to give you, 177 pips. Okay, it takes off again. Okay, you could use your 200 pips approach on the other side as it goes into profit. However you want to do it, but that way, you see here, you could have rode the move out and caught the trend. I mean, that's a very long trade, but that's the way I was planning this one out, is a 200 pips at a time on the way up, looking at it as this thing's eventually going to drive, you know, 2,000 pips in our favor. Okay, so, you know, this stuff is, it's hard to really cover all the different possibilities and examples in a short little webinar, but the best thing I can suggest is just over the weekend, as with a lot of the other stuff I've taught in these webinars, is over the weekend go back and practice this stuff while the charts and markets are closed. You can definitely do what I'm doing. Just go back and scroll back in time, just stop at some point, and then hit the F12 button and start practicing the markets. And applying, you know, just paper trading here. You don't do anything with your account or even a demo. You just, you know, grab a spreadsheet or grab a piece of paper and pencil and start writing out what you would be doing. And start to try to adapt this to your strategy. Figure out, you know, in this example, how many pips did you need apart? Maybe you would have gave yourself more room or less room on this example. How many times are you going to need to scale out? Are you going to just take out, you know, half your trade, a quarter of your trade? Or are you going to give it more than that? More room than that. Okay, so I hope you guys can go out and practice this stuff, and next week put it to action. You know, put it to use on your charts in, you know, a demo account. Start playing with it. But don't give it, like I say, don't just try it a few days or a few weeks. Consistently practice this like anything else, and over time you will be successful with it. All professional traders know how this concept works and are very successful at applying it. And you guys can figure it out too, I know it. Okay, so I think we're going to close things down. I really appreciate everybody coming to these webinars and taking the time out of your day to attend. And I hope everybody has a great weekend. We'll get the recording up Monday and shoot you guys an email. Thanks again.